4 in a row, right?
I think so. All right, Ari, thanks for joining us. Excited to talk about distributed ledger, cryptocurrency. But first, let's play a game.
Thanks for having me, Ash. In college, I was a semi-professional poker player, but I definitely wouldn't be semi-professional at Connect 4.
I think that means I'm going to lose.
We'll see how this goes.
You're first? Guests go first. All right, that was going to be my move. So let's start at the very beginning. So we know that people have made a lot of money trading these assets, but what's the real world application for someone who's not been involved in the crypto space? How are these technologies potentially going to change the world?
The first use case that was the vision of Satoshi was P2P electronic cash. That was actually the subtitle of the Satoshi white paper. And the idea was to have sound money, money that can't be depreciated by central banks, money that is resistant to censorship, meaning, let's say I want to send a transaction to a gambling site, or maybe something like WikiLeaks. Currently, banks can censor me, or the SWIFT system can censor me. So censorship resistant. And then last is also seizure resistant. So it's an asset that can't be confiscated, or is at least resistant to being confiscated, where in the US that might not be that valuable to us, but you imagine a citizen in Russia or China or Venezuela or Iran or much of the world where they have to be concerned about corrupt law enforcement or the government itself literally confiscating their assets. So cryptocurrency, the first use case was as money that is more secure kind of in every way than fiat. Since then, there's been the scope of what cryptocurrency is trying to be has enlarged tremendously. Bitcoin was the first cryptocurrency and was really focused on that sound money use case. Ethereum captured a lot of, particularly Silicon Valley imagination as being a much broader, tackling a much broader landscape of use cases. So Ethereum is aiming to be kind of a world computer, a platform for decentralized applications. And I won't get too technical, but it's a Turing-complete programming base, meaning you can program anything. So any application that can exist, you could theoretically build it. And so some of the things—
build it in a distributed way.
Right. And that's the key part. So something people in the crypto industry right now are puzzling through is what use cases make sense to decentralize. So a few examples are, something in the news a lot has been the privacy concerns around Facebook and other large kind of data providers. So imagine a decentralized Facebook where the user owns and controls their data, where literally I get the benefit of software from a company like Facebook that has all of these developers, but they never ever see any of my data. So all of the data is encrypted. So that's one example. Near-term use cases, I think one that's powerful is remittances. So right now, people who are of any level of wealth, but it tends to be effectively a regressive tax, people are paying $20 a transaction to Western Union, for example. They want to send $100 from the US to their parents in India, and they're paying outrageous fees. So cryptocurrency for remittance, something that's being focused on right now is securitizing real-world assets. So we do this with equitization. So gold, for example, is an equity. So GLD is a stock. It's an ETF, an exchange-traded fund, and I can buy it in my 401k. And the benefit of that is it's more liquid, it's more divisible. So I don't have to buy an ounce of gold. I can buy kind of a fraction of a share. It's easier to transfer, and I'm not at risk of being robbed because I don't have to store the physical gold. There's downsides to that as well. And so we also do the same for real estate. So there are REITs, which I can take 100 commercial real estate buildings, package them as an equity, and then someone can buy one share for $20, getting fractional ownership. So the next step of that is going to be tokenization. And it's very similar to equitization, which is we take something like real estate or gold and we tokenize it. So there's a token representation of it. That still relies on the traditional legal infrastructure and the traditional world because there's a physical asset somewhere we need a legal system to protect. But the benefits of that is, for example, right now, let's say you own a share on the New York Stock Exchange. It's very hard to transfer that share to Japan, to trade it, to sell it. It kind of exists locally on an exchange. The benefit of tokens is they can be transferred 24/7, so you don't have to worry about trading hours or an exchange shutdown. You get a global pool of liquidity because these tokens can be transferred anywhere in the world almost instantly, almost for free. And they're programmable. So I actually think regulators are really going to like this because the regulator can actually, in the code itself, put in regulation about, for example, AML KYC, anti-money laundering. So they can build that into the protocol saying, you're only allowed to buy this asset, or you can only sell this asset to someone who's gone through our procedure as regulators. So I could answer this question for hours. I'll stop there. But there's a huge variety of use cases.
One of the interesting things about what you just said is the phrase regulators are going to like this, which isn't something you necessarily hear a whole lot of in the crypto space. Your background is actually very interesting. You're not a computer science guy. You're someone who went to grad school for finance, econometrics, statistics. You actually were a portfolio manager at the University of Chicago Endowment, so a very traditional finance background. You could have been on the Real Vision platform talking about other asset classes. How did you get into this space, and what attracted you?
Yeah, my background was kind of the two ends of traditional finance. So I started as a trader. I was a trader for 6 years, a market maker at Susquehanna National Group, which is a big market making firm, trading equity options, commodities, treasury bonds. And then I was a portfolio manager at the University of Chicago Endowment, which is very long-term asset allocation, high-level strategy, as well as actually investing in fund managers and underwriting fund managers, which is an interesting. Not only are you asking the question of how do I want to invest in terms of real estate versus equity, you're also trying to figure out who can actually capture alpha and what strategies in an ongoing way. So I was really drawn to cryptocurrency for three reasons. One, after the 2008 crisis, the central banks of the world were printing tons of money, and I knew that wouldn't be inflationary for a while. Mm-hmm. It takes a long time for a debt crisis to unwind, but I said to myself, I want to get out of fiat sometime in the next 5 years. And what does it mean to get out of fiat? It means that if central banks are going to print more dollars, more Swiss francs, more yen, if currencies around the world will be competitively depreciating. One example of that was after World War I, many of the central banks around the world started printing as much money as they could. And so it's weird thinking about currency depreciation because usually it's relative to another currency. Mm-hmm. What happens if both the Swiss franc and the yen and the US dollar are all printing? Their exchange rates might not move against each other, but they'll all devalue relative to real goods.
So a decline in purchasing power, basically.
Exactly. So I thought that was likely to happen, and so I started looking for what assets do I want to invest in if that's going to happen. And it took me a long time to realize that Bitcoin was potentially an interesting asset in that regard because it has fixed supply, 21 million coins. It's depreciation resistant. So I think it potentially plays a little bit of a similar role to gold in a portfolio in that one regard. It does a lot of things, but that's one thing that drew me to it. The second was trading and traditional investing. It has become increasingly commoditized. So machine learning algorithms have replaced many discretionary traders and screen traders. And investing is just a fairly mature field. So you compare where we are, now the debate about Microsoft stock will come down to should it be trading at a price to earnings ratio of 15 or 20. But everyone kind of is using roughly the same models. Everyone's using the same, there's general agreement. Whereas in cryptocurrency, it's like we're pre-Benjamin Graham. It's like the debate right now is there a price to earnings ratio, and if so, what is it? And there's such incredible disagreement. Someone will suggest a model like a price to earnings ratio, and someone like me will say, no, that means nothing. We're at that level. So that's intellectually fascinating. The opportunity to be an investor and figure this out as we go along is just fascinating to me. And as a trader, it's an incredibly inefficient market. It seems like, this is before my time, but commodities in the 1970s, corporate bonds in the 1800s, things that I'd only read about of kind of massive inefficiencies that as a trader you could capture or see in the crypto market. And then the last was I had a lot of relatives who were in
Those of us who worked on desks have heard this for years, right? And I was in the muni bond space for a while, and you heard the traders saying, my God, when I got into this business, right, we could work like this, and now we're working like that. So tell us, that's a great lead-in. Tell me about more about the valuation models in crypto, how you think about it, how you think about investments, and what your framework is. Sure.
This is a really important question that is probably one of the least answered in cryptocurrency. There's nothing approaching consensus on valuation. One issue is the term cryptocurrency is somewhat misleading. The assets can have wildly different economic models. So some cryptocurrencies are really more are fairly close to equity. Some cryptocurrencies are like currencies, and some are like commodities, and they're radically different in terms of the underlying economics. For example, there's some cryptocurrencies that are connected to a for-profit company, and either by promise or by contract, indirectly have a right to cash flows. So as an example, and we don't own this coin, so that's the disclosure. I have no conflict on this. Binance Coin is a coin of the Binance Exchange. And Binance takes some of their trading revenue and uses it to buy back the Binance Coin. So it's almost like a share buyback. Now, the coins don't necessarily have the same rights as equity, so there are critical differences, but you can kind of do a discounted cash flow model for that crypto asset. Bitcoin, on the other hand, there's no cash flows at all. It's much closer to gold. Bitcoin's actually the only thing that I feel like I have a decent valuation framework within one order of magnitude. So the model in my head, and this is hotly debated, so I don't mean to suggest this is the right answer, but it's kind of my framework at the moment. I think Bitcoin is tackling the addressable market of the offshore banking system. So right now there's about $20 to $30 trillion stored in offshore banks. And there's a lot of reasons for that. One is a regulatory or tax arbitrage, so companies can potentially save a lot of money in taxes. But one reason is as that seizure resistance or judgment resistance. As an example, Amazon and Apple have their assets scattered throughout the offshore banking system. And one of the reasons they do that is imagine if Amazon had all of their money in a single bank in New York State. One judge in New York could freeze that bank account pre-trial, and Amazon would have to shut down the next day. They couldn't make payroll. So Amazon, it's not that they want to get away with illegal activity, but they want to have their day in court. So they have assets across many jurisdictions where if that judge freezes that bank account, or if the judge issues an order to freeze all the bank accounts, Amazon will have probably 5 years of appeals. They'll get their day in court, and they'll get multiple appeals in court in front of different judges in different legal systems. So there's tremendous demand for, I think the question asked is if everyone in the world could have a Swiss bank at basically zero cost, and they could do it with just $1,000, what would the demand be for that service? For a way to store an asset that no police officer, no judge can arbitrarily seize from you, that you at least would get kind of this lengthy appeals process. And during that appeals process, you could access your assets and pay for lawyers, for example.
That's a very nuanced point. I think many people who are sort of skeptical about the crypto space imply that the reason that people want assets in different jurisdictions is to facilitate illicit activity. And that's a very interesting point.
Yeah, I think that example is kind of my conversion for Wall Streeters. So different people see different parts of the puzzle. A lot of people on Wall Street will ask the question of, I see the value for criminals, and by pointing out, look, every S&P 500 company does this. Amazon and Apple have huge amounts stored in the offshore banking system for very clear reason, right? Because you might have a capricious judge, right? So we can have faith in the legal system while not wanting to put the fate of Amazon in the hands of every individual judge who might hear your case.
Very interesting. So let's talk about some of the things that you find most interesting now. I know you're involved in crypto asset custody. Could you tell us a little bit about that?
Sure. So a major impediment to broader adoption of cryptocurrency is custody. It's kind of terrifying. To move cryptocurrency right now generally requires copying and pasting a public key or a public address, which is a string of letters and numbers that looks very arcane. And if you mess up, but there are some protections built into the protocols. But if you mess up, potentially your money's gone. That's terrifying, and it should be terrifying. I think it's somewhat similar to the earliest days of email where people would have to actually, the first email users would compile their email, and they would do it from a command line interface, and it was often buggy, and the message often wouldn't get through. And then eventually things become streamlined and abstracted. So I think in cryptocurrency, we'll abstract that layer where you'll be able to send crypto to a phone number or an email address. We're going to have private key recovery options, basically ways that if you were to lose your private key, the key associated with that shows ownership of your cryptocurrency, there'll be all sorts of different ways that you can recover it, and you'll be able to choose kind of basically who you want to trust. And you could potentially trust a bank or a fiduciary. So currently, you kind of have to self-custody your crypto assets. Self-custody basically means that as an individual, you have control of your asset. So this is in contrast to stock, for example. If you own Microsoft stock, you don't physically have it, for most people at least. There are physical stock certificates, but today people generally don't touch it. And so you can't lose your Microsoft stock. Your Microsoft stock is held for you by a broker who holds it with a custodian. And that gives you a lot of protection. You can't be held up at gunpoint. You can't lose it. With cryptocurrency currently, even institutions, hedge funds, VC funds have to hold their own crypto assets, which is a major risk for investors. And the reason for that is we don't yet have the custodial infrastructure, but it is being built very quickly. So I'm actually optimistic by the end of this year, there'll be a institutional quality custodial solution that has all of the regulatory framework. So they have to be, there's a term qualified custodian that basically means the SEC or a state has signed off on this custodian for financial assets. There's the technological infrastructure. So a custodian, you have to assume they're going to be the biggest hacking targets in the world. So Coinbase at one point had $20 billion in crypto assets. And that's a very attractive target to steal because you can potentially get away with it in ways that would be far harder to steal 20 billion in US dollars. So you need really, really strong hardware and software security. You need operational processes in place to prevent social engineering. And that's, there's 6, I'd say, credible custodians that are all racing to market. And some of them have launched beta products, others very soon will. So at the moment
For retail and institutional clients?
Yes, absolutely. There's already some decent solutions for retail. They're a little bit on the engineering heavy side. They don't require engineering, but for example, they're hardware wallets. I would actually say for anyone watching this, if you own cryptocurrency, if you leave it on Coinbase or another exchange or broker, you have counterparty risk to that company. So if you have your Bitcoin on Coinbase and Coinbase goes bankrupt, you probably don't get your Bitcoin.
I mean, many owners of crypto actually custody their own keys to avoid that problem. Is that right?
Absolutely, and there are decent solutions for that. So hardware wallets like the Trezor or Ledger, which are customized hardware that are quite ingenious in that you can plug the device into a computer that has a virus and your private key should still be safe. What's kind of lacking is really more the institutional side, which is you as an individual can have a pretty good security solution, but you don't have an operational solution. What do I mean by that? Well, currently, it's very, very hard. As an institution, generally, there isn't one person who's supposed to have legal access to the funds. If you're an endowment, for example, the CIO is not supposed to be able to walk away with the money. You have a process in place. You require, say, 3 confirmations. The CIO signs off on it, the fund administrator, maybe someone else at the endowment. So that's kind of what's lacking. It's this intersection of...
In some ways, interestingly, that type of solution is actually anathema to many retail holders of cryptocurrency. What sort of resistance do you meet, or what sort of response do you meet when you make those arguments?
Absolutely. There's a real cypherpunk idealism in the crypto community, particularly around the Bitcoin community, but around some others, that say if you don't hold the private keys, it's not your cryptocurrency. And this idea that we should all be self-sovereign, meaning we should all own our own money, we should all be able to define what our own money is by running our own software that literally defines what rules we are going to call our Bitcoin. So there's definitely a little bit of pushback. My view is the more options, the better. So no one will ever have their arms twisted to custody with a third party. But for some people, for an institution, you might want that, you might need it. My hope is that we get a suite of secure solutions that people can pick and choose from.
That may have been the worst move in the history of Connect 4. It's a brilliant Connect 3 move
I was a little bit happy when I saw it, I won't lie. It's a good thing there's no tells in this, right? Don't have to stare into your soul.
So one of the things that we've touched on is the direction, your vision of the future of the crypto space. So tell us a little bit about, in the short term and in the intermediate term, where you see things going next.
Short term, I think there's a few use cases that are finally ready. So a question that gets asked a lot is Bitcoin's now almost 10 years old. It has about 30 million owners, very roughly, and very few active users. And that's true of the broader cryptocurrency world. There's a lot of projects and very few users. And so what's the disconnect there? A lot of the use cases, the technology didn't exist to support them. So scaling is focused on a lot. The Bitcoin can handle right now about 14 transactions per second, which is not enough for complex computation, let alone even Visa-level transactions.
By way of contrast, Visa is able to do about 25,000 transactions per second or something.
Correct. And if we're talking about running applications, you need even far more than that. What's happened in the last year is a lot of these, scaling is one example. What's happened in the last year is a lot of these technological impediments have been solved or are close to being solved. So scaling, for example, use something called sidechains that give you close to Ethereum level security with almost infinite scalability.
Explain what a sidechain is.
Sure. So a sidechain, it's a little bit like what it sounds like. So with Ethereum, you have a chain that is the Ethereum blockchain, and a sidechain is a separate chain that in some way connects to Ethereum. And the idea is, for a lot of things, we don't necessarily need everyone in Ethereum to see every computation. So is there a way that we can get the Ethereum security while having a chain, for example, that only two of us see. So I'll give a really simple example. If we're playing a game like Connect 4 or chess, let's say we want to bet on that game. Well, we don't need all of Ethereum to see every move and to be able to verify every move. Here's a fun example. There's something called counterfactual instantiation, which sounds more complex than it is. It's actually a very simple idea. So imagine if we play a game on a sidechain, and every move is cryptographically signed, so we both have proof of the game as it plays out. And at the end of the game, if you and I agree about who won, we just post the result to the Ethereum chain. If you and I disagree, the entire game gets replayed on the Ethereum's main chain, and the winner gets the payment, and the loser pays for the challenge. So game theory would suggest that the loser is going to know they're going to lose, and so they probably won't challenge. So 99.9% of the time, the sidechain works by itself, and all we need is a single computation on the Ethereum main chain instead of this entire game. That's
so the idea is basically to conserve bandwidth, to increase speed, and to maintain the security that a full chain structure would allow. So,
exactly. And so that facilitates, with sidechains, we can now do games. Whereas before games were far too computational, too bandwidth intensive.
Right, if they all had to be played out on the main chain, every move.
Absolutely. Another element is that until recently, you didn't have many UI-focused people in cryptocurrency. It was a lot of engineers, a lot of cryptographers. Now you're getting product managers, you're getting people from Square and Facebook and Twitter who know how to build an interface that people want to use. They know how to build a product that is a game that's fun to play, for example. So you're finally getting kind of the consumer-focused people into cryptocurrency. And so I think the first wave of applications we're going to start seeing in the next year that start getting mainstream usage. I mentioned remittances. I think we'll see that over the next year. Crypto games. That can take a few different forms. One really straightforward one is there are people who in Game of War or Fortnite spend tens of thousands of dollars in the game. It's really it's staggering. So more than 1,000 people, actually, I don't want to say 1,000, more than 100 people have spent $10,000 in Game of War, for example. There's actually a few people who've spent more than $1 million in Game of War. And what's amazing is Game of War, if the company goes bankrupt, if the game loses interest generally, or if the company decides to just take your asset, your value's gone. So imagine if ownership of whatever you purchased in game was actually decentralized and was stored on a blockchain. And so the game developers could produce the game mechanics and the game graphics and all of that, but your ownership existed independently. So what that would facilitate is I think really interesting economic incentives to create gaming ecosystems where you can transfer your items across games.
And it's interesting, it's coming back full circle. This is kind of one of the drivers of the creation of cryptocurrency in the first place, was in these online games.
Absolutely. And it's one of the reasons, so South Korea has been one of the fastest adopters of cryptocurrency, I think partly because they're so familiar with the value in digital worlds, right? In the US, people sometimes say like, well, how could virtual land in sim life be worth tens of thousands of dollars? And there's a new generation of people all around the world, but particularly in South Korea, to a lesser degree Japan and the US, who grow up with the virtual world being a meaningful part of their life and who are getting used to spending thousands of dollars on virtual goods, and where esports are becoming like sports, and where the top esports players make $1 million a year. So I think we're going to see some popular crypto games. I think maybe within the next year, a little bit longer term, kind of sky's the limit. So there's some somewhat basic use cases where it's just about decentralizing. So for example, gambling, where you have provably fair gambling, so you don't have to worry the gambling site is ripping you off because the calculations on the gambling are actually visible. You also don't have to worry about counterparty risk to an online gambling site. I was a poker player in college, and some of my friends lost money in Black Friday, which was a day when a bunch of poker sites got shut down, and a lot of the money on those sites just vanished, and players never were able to take their money back. So you could potentially have non-custodial gambling where the site doesn't hold your money. So those are some very limited use cases. I think what's more interesting is a good way of framing cryptocurrency is it's a novel way of coordinating human activity. So Nick Szabo, who invented the term smart contract and created a precursor to Bitcoin, wrote a wonderful essay on social scalability. If you search for Szabo or social scalability on the internet, and his last name is Szabo, wonderful essay. And he makes this argument that humans evolved probably to be in communities of about 100 people, maybe 50, maybe 200. And going beyond that taxes our mental ability. And so we have to abstract. There's no way to build trust with thousands of people on a kind of retail basis, person by person. So what we end up doing, so the legal system helps us, right? So I can enter into a contract with you. I can trust that there is a legal infrastructure in the US that will enforce that contract. We encounter some real problems, though. A very clear one is, for example, if a business in the US wants to do business with a company in China, they don't trust each other's legal systems. They're not sure if they'll be able to enforce a contract. And so there's a lot of valuable economic activity that never happens because we can't coordinate. So, and of course, the legal system is incredibly expensive, incredibly onerous, incredibly burdensome in many, many ways, including even if something never goes to trial, the cost of having everything, have a contract associated with it that's 80 pages long and involves legal review.
Especially for smaller scale transactions.
Absolutely. So blockchains and cryptocurrency are a way potentially of creating alternative ways of building trust or trust minimization. So it's interesting. You can argue it. You can frame it in either way. You can say cryptocurrency is about not trusting. There's no counterparty. There's no person. There's no legal system. There's no judge you have to trust. Or you can frame it the other way, which is it's a way to trust more. So the problem isn't that we trust too much. It's in some ways that we can't, for good reason, trust enough. I can't trust that the Chinese government will enforce a contract. I can't necessarily trust that. This is true even state by state. For example, California does not respect employment contracts that are okay in New York. So you have issues there. So on that theme of coordinating economic activity, I think it's very hard to predict. It's a little bit like when the internet provided the advertising revenue model. It was hard to know what that would lead to. It was an entirely new, it for the first time let you easily monetize eyeballs.
And also something that no one guessed at in 1997 or 1998, that advertising was going to be the killer application.
Absolutely, and it created entirely new business models for content generation and distribution. So there's some elements of this that I think are hard to predict. As people gain new tools to coordinate economic activity, what will they do with them? But there are a few that we can kind of think of. So one example would be blending kind of wet and dry law. So if dry law is the actual legal contract and wet law is kind of the human element involved with that, it's important to recognize that law as we know it is really more wet than dry. So it's not about the physical contract, it's about meeting of the minds, it's about precedent and what a judge will interpret. We're never going to do away with that entirely. So people who think a smart contract will fully replace traditional contracts, probably, that I think that's way off. But there's certain elements that we can potentially automate. Especially as more and more work and more of our lives is digital, there's more that we can put into a smart contract that is a very simple if-then statement. If you do this, then this payment is made. I think that one way I think this plays out, and this ties into micropayments, imagine if programs can pay programs algorithmically. So let's say I run a decentralized Facebook and I need to rent file storage. Let's say I can rent that millisecond by millisecond and I can pay thousandth of a penny by thousandth of a penny dynamically as I need it. That's probably a dumb example. That's not that interesting. That's just kind of shortening the time frame and the payment size. But we're moving into a world where more and more, not just you won't have human companies that then need to use digital medium to do one payment. We're going to have more things that are digital native. So we can imagine a DAO, a decentralized autonomous organization, which is kind of a virtual company. And it could be entirely virtual with no humans involved, or it could involve human voting via token ownership. And that DAO might, for example, earn revenue by doing some service and then put out a help wanted ad to put up additional marketing and then hire additional people using Elance, which is a little bit of a decentralized hiring platform, to then build additional services. And all of that could happen within the program natively, real time, micro, So I think it's hard to predict specifics, but this idea of semi-automating, and the semi is important, but not fully automating, but semi-automating business activity as we move increasingly digital.
So we covered scalability. Let's talk about some of the other challenges in the distributed ledger crypto space. So one of the things that's been brought up recently is the degree of environmental impact that essentially doing proof of work transactions is creating. There's some statistic out, I think it's PricewaterhouseCoopers, that said that the amount of electricity used to mine Bitcoin is similar to the amount of power required to power Ireland. So where are we with that? Do you see a technological solution on the horizon, or is this something that we're going to have to deal with for the time being?
This is a bit of a deep philosophical question and a game theory question over whether that's necessary. So there's a lot of other consensus mechanisms. So proof of work is one possible way of securing a network. There's a lot that require close to zero electricity, and we don't know if they work. So there's and this is kind of being debated right now. I think we probably won't know the answer for a decade because it's probably going to have to be empirical. Meaning we're probably going to implement alternatives and we'll see if they hold up under massive economic incentive to destroy and attack those networks. But the idea is that if you want to have something of value, it probably needs something valuable backing it. And people often say, well, Bitcoin has nothing behind it, right? Why is it valuable if it's not connected to anything real world? And it is connected to something real world, which is a massive amount spent on electricity, spent on work. And the idea is that that proof of work is a really critical concept. And I think it's actually useful specifying this in kind of practical, technical terms because it's just a clear example. So if I've downloaded the Bitcoin software, but I haven't connected to the network in 5 years, I can connect to the network and be confident that, let's say my computer receives 10 competing versions of Bitcoin. So Bitcoin has hard forked. It's hard forked many times. It'll likely continue. How do I know which is the real Bitcoin? Well, I can very easily computationally prove which chain had the most electricity that went into it. The idea is it's one of the only objective things almost in life, so any other scheme, not any, but most that are being proposed requires some element of human discretion. So this is kind of an objective way of saying this is the thing that people have collectively poured the most value into. Doesn't mean it's the best, doesn't mean it's the most widely adopted, but it's a clear kind of objective measure that allows the world to reach consensus on what is the valid chain. And one idea here is it's not that the work itself is valuable or important. What's important is that we have a method of everyone in the world agreeing what is valid. It might not even matter as much what the valid thing is. So let me give you an example. Imagine two versions of Bitcoin with a tiny rule change, and that rule change is almost negligible. So let's say it was 21 million coins versus 22 million coins. Not a huge difference, right? It probably doesn't matter that much which one Satoshi had picked or which one we use today. What matters is that we all agree. So the problem occurs if I, as a standalone user, have no idea what the real Bitcoin is or what a valid transaction is. And the reason, and you might say, well, isn't it easy to just publish somewhere and agree? The problem is we assume that these decentralized networks will be the subject of coordinated attack at a massive scale. So there's already hundreds of billions of dollars of value to attack. There are probably state-level actors that will try to attack these networks to the extent that, for example, when we were talking about the reason I got into crypto, we didn't get to the third, and it's actually really important and ties into this, which is, so I had relatives who, some survived, some didn't, the Holocaust. And refugees around the world, there's a stereotype that refugees tend to be impoverished. And a lot of that comes from the fact that they're impoverished when they get there because they had to leave their wealth behind. So a lot of people don't flee as quickly as they would because they have to flee as paupers and they have to risk starvation. And they have to, you have a lot of middle-class refugees who are middle class when they leave. So we look at China now. China is, they've launched their social credit system. They're working on crypto yuan. And crypto yuan would be a currency that the Chinese government has complete and total control over, both in terms of real-time monitoring and also in terms of being able to flip a switch and turn off your money. And I think they're very likely to ban all other money. So what that means is that if the Chinese government doesn't like you, they can literally cut you off from the economy, and no one can give you money because the money will only be digital. If, let's say, Bitcoin is used by the 10 or 20% of Chinese people who are out of favor with the government as a money that the Chinese government can't easily turn off, the Chinese government may attack Bitcoin. And other countries as well. So in that world where China has something like well over 100,000 people whose only job is to spread propaganda on social media, they actually use the word propaganda. That's not my labeling. Imagine a world where I, as a Bitcoin user, am inundated by misinformation. How can I figure it out? Coordinated economic attacks at massive scale. So the idea is to create a cockroach, something that could survive a nuclear war, something that is incredibly, incredibly resilient to attacks by state actors, to disinformation, to economically incentivized attack by corporate-style actors, to survive hacking of all types. And that comes with a big cost. So it's definitely a radical inefficiency. It's definitely incredibly expensive. It may be environmentally unfriendly. The argument mostly is that electricity will only be spent if society is getting something of equal value or greater. Similar with anything. So gold mining, for example, per dollar of value is substantially worse for the environment. And some would argue one of the initial motivations of Satoshi and some of the early cypherpunks is an idea that, and this we start getting into a little bit of political sci-fi type ideas, the idea that many wars, possibly almost all of them, have been financed out of debt. So there's an idea that, for example, if the US citizen had known how much the Iraq war was going to cost and had to pay for it up front, would they have voted yes? Would they have supported the war? And so there's an idea that if we have money that can't be printed, that may even reduce war. And I'm tying the reason I'm connecting this to the answer to this question is because you could say that the value of the US dollar is backed by the US military. And how expensive is the US military? Not that we wouldn't need a military, but would we need a military that's 4 times larger than the next largest in the entire world? If we had a currency that wasn't pieces of paper backed by the full faith of the US government. So I think it's important to juxtapose the cost of securing the Bitcoin network. The comparison point is not the cost of a Visa transaction or all of them, it's the cost of the entire infrastructure supporting fiat, which is every bank, the entire legal system, and parts of the military.
It's a very interesting and deep philosophical point. No, that move really was that bad. You can play it.
I think that's it.
All right, I think you got me. Rookie mistake here in Connect 4, but we covered a lot of ground. We talked a lot about scalability. We talked about some interesting use cases that you see coming down the pipe in the crypto space. And we talked about custody, which I think is a really crucial and interesting issue. Thank you very much for joining us.
Thanks for having me. Great conversation. Maybe not the best Connect 4 game.
No, it was terrible. It was just appalling.